Morning, y'all. Good morning. Good morning. Um, okay, just pulling up a few bits and bobs. Right then, so it's the middle of the week, and we can expect decent sized moves because we've had Monday and Tuesday setting us up. Um, what am I looking for? 1 moment. Right, let's have a little look into what we've got for the day ahead then. Um, I'm mainly focused on the red calendar events, and for that we've got the FOMC, and then tonight we've got the Aussie employment data. Um, 1 moment. Okay, that's what I need to do. Gotcha. Okay, whatever. Get rid of this thing. Right, there we go. So FOMC minutes and Aussie data. This is going to, okay, so looking at the dollar and FOMC minutes and US yields, if you recall, earlier this week we had retail sales that were strong, but we've also had a series of softer or soft-ish inflation data out of the US. Um, and ahead of next month's meeting, which is around the corner, these FOMC minutes are going to be very important. Um, the the US economy essentially is continuing to run hot. Um, but the recent softish inflation data has supported a skip in a rate hike in September. Although that data out of the retail sector is complicating things. Just taking a question here. Was there any conclusion as to why the dollar was bearish yesterday after the initial spikes in retail sales? Well, for me, it's all ebb and flow. Um, I don't rely on one data point to dictate a continuous trend in any pair. Where there's money to be had, the market will go there. So if you get a spike up, you've got people in the money. You've got stops, and that is food for the market. So yeah, the sooner, in my opinion, and others do very well out of it. I don't know how, but the sooner you move away from relying on data and pure sentiment and data in the market and move towards following price action and understanding where there's a void in the market, when you've got a displacement and a rally, you're going to get that pullback. Relying on data alone is not going to get you very far. On the other hand, if you're an investor and if you're trading, macro investment style, then you're going to take a longer term view and the data is going to help you. But you're usually well ahead of the data and you're already invested in the sentiment around the performance of any particular economy that you're targeting or region of the world. But when it comes to day trading Forex, indeed, I mean, if you're swing trading Forex, then the data is likely going to either support your trade or go against it, because that can have effect. It can have a longer term effect, but for purely day trading, relying purely on data is detrimental. Day trading is about where was the market yesterday, open and closing prices, highs and lows, where is the money? Where are the stops? Where is the market coiled? Where is there a void? Where is there a space to target? We'll go through that at some point. I mean, I've tried to drill that in through the educational videos. We're still early stages with that education, but do go through those videos and you'll start to see what angle I'm coming from. Yeah, exactly. Data, sentiment, price action, finding value. Correct. Hunting down the bargains. What's cheap? What's expensive? So just sticking then with these FOMC minutes, um, we've got an economy here that's still growing above trend, and we can't write off the prospects of higher inflation down the line. And that is what these Fed speakers are drilling down on, which the market, for whatever reason, doesn't seem to be picking up on. Um, well, having said that, you've got world interest rates presumptions suggesting that there are still 10% odds of a hike in September, but they're rising. They are rising to 40% in November. So just keep that in mind. Um, I mean, Kashkari, Fed speaker, who was speaking yesterday, he was giving us some hawkish guidance as well, and and he was asked if they were done with rates, and he said that they weren't ready to be. He said they're not ready to say that they're done, but he is saying positive signs, um, but there may be more on the way. So essentially, it's data dependent. Now, these FOMC minutes today then are going to be very important. They're from the July 26th meeting, and the Fed did hike rates by 25 basis points at that meeting, and they were noting that that economic activity had been expanding at a moderate pace, and they were also talking about a robust labour market over the recent months, and that unemployment remained low, um, and that inflation remained elevated. So there was some hawkishness there. And then Powell was also speaking, and he was also stressing that the Fed hasn't made a decision to hike at every other meeting, and said that they'd only hike in September if the data warranted. He also noted that the slowdown in CPI in June was only 1 month, and that the Fed needs to stay on task, and that the Fed needs to hold rates for some time. So all of that to me is all pretty hawkish. Um, Now with the minutes today, if we get anything uberly dovish, then that's going to seriously knock some wind out of the US dollar, because the dollar is still elevated. And you ask there, why did it run higher? No, why did it come off after the retail sales? Let's have a look at the chart. So we've got this how many days? One, two, three, four, 4 days of higher closes. Let me share this chart. Um, share your screen. Share your screen. There we go. Go live. Okay. So looking at this US dollar, this is the DXY index. Measures the dollar against a basket of currencies. Um, the major component of this index is the euro, about 40 odd percent, 45%, something like that. So we've got 4 days of uh, rise, okay, high closes in this dollar index, and it's starting to park up top, right? So you've got this range, and it's parking up in this upper level over here, the upper third of that range. We're still trading well within last month's range, which is all of this, between these red dotted lines. But even still, we're in the upper end, the very upper end of that tranche between last week's highs and last month's highs. Okay, so all up in here, right? So that in itself, we were talking about where's the value. That in itself shows that the dollar is, I don't want to say overpriced, but it's expensive. It's high up, potentially out of balance, right? So if you can look at it that way. So where's the path of least resistance? Anyone want to hazard a guess? I'll give you a few seconds. Who wants to jump in? Where do you think the path of least resistance is going to be? Okay. Anyone else? Doo-doo. Who's in the money? Who's making money out of this dollar rising? And the market doesn't let you stay in the money for very long. Right, there we go. We're starting to get some. Okay, exactly. So those that are starting to see that once this market, look how high it is. It's right up here out of this month's range. And if you just split this up into fifths, it's at the upper fifth of the box. This is 3/3. So it's right at the upper end of that box. So those that are in the money are those that were buying the dollar down in below the 100 figure versus whatever currencies, and they're in profit. And there's hardly been any pullback. So you've got this stairs, and then you've got the elevator down scenario, right? So we've got this support structure. We've got a market here that's not going any higher. It's just sort of coiling. And when you see a market that's starting to condense and coil, move sideways in a box like this, you've got to be thinking, well, either this is going to continue vigorously. So think of it as a coil, a spring. When you tighten that spring, the reaction in the market is something fierce, right? So you'll get all that energy that's pent up and an explosive move. So it's either going to explode to the upside This is the thesis, or to the downside. And noting where this is in the range of the month, the bias, considering it's right up at the top, the bias, the path of least resistance is to the downside. So it's coiling like this, all that energy being pumped up, and then boom. Or if we flip it the other way, coiling, explosion to the upside. So this is what I've been advocating this week. I've been looking for a weaker dollar. Haven't had it so far, really. We've had moments of weakness as we've come into our session, mostly. Right, this is a peak formation here. So these spikes usually met with a spike down as well. So we've got that spike up, spike down. We've got a peak formation low. Peak formation high. Oops. Peak formation low. So what can we expect now? A peak formation high? So maybe we're pumping up at the moment into these shorts. And then what do we expect? Peak formation high to come down. And in doing so, we'll be breaking this trend line and carving out our bearish thesis as we break these lows here, here. Can't see to mark it. Here and here for the continuation to the downside. So let's just have a quick look at yields. They tend to guide us one way or another. If I can open this thing over here, 1 minute. There we go. Right, so we're high up in the month's range, in last month's range. Okay, these red lines are last month's range. In the dollar, we've had a series of days in the money or long, higher closes. We are coming up into yesterday's closing price. We might see a move to the downside. Everyone follow? Going over to the 10-year. Can't we say that every higher high made there? Well, we've had higher highs, we've had higher lows, but over here we've now got a lower high, haven't we? Well, having said that, we don't know yet. This here could be, so this could be a strong high. This could be the culprit of a new lower low. So I'm just reading someone's question in the chat. So yes, we've got a lower, we've got a higher low, we've got a higher low, right? So we came up, higher high, higher low, lower high. This could be a lower swing high, and we're waiting to see if we get a lower low. So this is what I'm saying is that more than likely, because we're trapped, well, we're not trapped yet, but we're up top of the last month's range. We've broken out of last week's highs. Most 80% of breakouts fail. So when we're breaking out of a level, such as a very important level, such as last week's high, you can be in anticipation of a move back inside. Okay, so that's what I'm literally banking on, right? I'm looking for my trades to benefit from dollar weakness. Does that answer your question, MX Hybe? Can't can't we say that every higher high made though? So yeah, there's been higher highs, but not yesterday. There was a higher high yesterday, but it then dropped down. This is on the 1 hour chart. Yeah, if you want to send me questions outside of the meeting, that's no problem. You've got my direct um, profile here on Discord. Just send me a message. You can write to me in French if you wish. Not that I speak French, but I can use Google Translate. That's not a problem. I speak Spanish, so I might be able to pick up on what you're saying in some form. Yeah, that's no problem. You don't need to apologize for any comment that you make. That's fine. Right, let's get over to yields. Oh, sorry, I'm on the yields. I see what you mean. Sorry. Right, bear with me. Okay, so we're talking about the Dixie and we're looking at higher highs. Right, one moment. So, we've got higher low, lower high, we've got a lower high over here. So this is a market that is starting to break down. So we've got these higher low, higher high, higher low, lower high, lower low, right? Equal high, resistance, right? And then we'll have to see what happens from here. But my best bet is sort of M-ish fat pattern as a move lower. Right? So we're starting to see a market that is breaking down, and the same thing there that we were looking at on yields. Same scenario. Now, if I pull these yields out to a daily chart, then we were talking earlier this week about this W formation. You can see it better on a line chart. That blue line. I'll get rid of all markings. In fact, get rid of all drawings. So you see that blue W formation. That is a reversion pattern. Ian uses harmonic patterns in his analysis for you guys. So you should be getting used to those types of patterns. I'm no expert on the actual harmonic patterns themselves, but I get the concept. Essentially, when you see something like this, it's bearish. Make that more visible. There it is. Right. So you've got that harmonic pattern. These are reversion patterns, and we're looking for the price to revert back to at least the neckline of the pattern. All right, so that's should be bearish for the US dollar. It's sort of got its own semi pattern itself, right? Looking bearish on the charts. So what does that give us for the currency board? Let's go to the euro. Again, if you want to use one of these patterns, we can on this as well. Okay, so that's bullish. Um, so you've got this M formation, and it's already starting to correct, as you can see, towards the neckline. So what does that give us for today? Right, this week, let's bring up my 3-day template. So this week we've started off on Monday smashing down peak formation, moving up, right, into consolidation, coming into Wednesday. This peak formation here could be the low of the week. It might not be, but it could be. So if that is the low of the week and we're already on Wednesday, then we'd expect the market to start making its move to the upside if it's yet to make a strong high for the week, right? So if the momentum from Monday's peak low is to push the market up, then we can expect Wednesday potentially to be a mover, right? And we've got, if we look for where is the market in the money, who's in the money? Anyone hazard a guess? Is it buyers or sellers? If I pull that out a bit, who is in the money? Buyers or sellers? Give you a clue. If we look on Thursday, what happened on Thursday? Is it Thursday? So buyers are in the money, are they? They're how are they in the money? If you bought on Monday, if you bought on Monday, and if you've been moving your stop up, if you've been training your stop, or if you're a swing trader, maybe you've got your stop below here, then yes. But where is most of this market positioned? If you look at Thursday, sellers, they've been selling short, short, short. So the money is all of this up here. So sellers are in the money. But they soon won't be if bulls take control and start stopping them out. Does that make sense? So yes, if you were saying buyers are in the money and you were talking about Monday this week and your stop is below, then yes, fantastic. You're in for a treat. You can use any time frame. Whether I'm getting asked here, how do you determine on which time frame for who is in the money? I'm talking about who's in the money over a period of days, right? So what I'm trying to do here is build up a thesis for each day on what is the bias with respect to what has happened over the past few days. So, for instance, as I said, if you were buying on Monday and you're swing trading in anticipation that this market is going to go up after the shorts from last week's sell-off, right? Because they're all in the money still. Yeah, they might be moving their stop loss to each daily high, for instance. Yeah, which is great for us because we know where their stops are, so we can go after those highs and squeeze them out. So that's why it's called a. These people are short, so it's a short squeeze that we're looking for. A short squeeze to attack each day's high, because that's where the stops are. Right. So I can determine today, for instance, who's in the money and where the stops are. Right. So today, Asia, they're buying. Okay, their stops are below the lows of the day. So on this hourly chart, these stops are being bought up. I don't know if I've got a tool to show, but after each hourly bar close or break in structure, let's say. So let's say the breaks in structures were perhaps that high there. This congestion area here, right? This point of control of yesterday, that orange line. So the midpoint of that range of the day. Last week's lows, that orange dotted line, right? When the market gets above that, oh, great, well, I'll move my stop up. And guess what? Bang, boom, right? Machine gun fire through those people's stops, right? Accelerating the trend lower. And they've come right into the point of control on the day, right? So a lot of people that were in the money were all squeezed out. Okay, so the market's done its job of not. It's not necessarily trying to squeeze everyone out. It's more trying to fill orders. Right, there are orders. This market has accelerated so fast that these buy orders are having to move up. To get filled. They could be corporations, large institutions, big investors, family investors, and so forth. Um, and the market needs to do its job, and that's fill orders. Right, the market makers have to, fill those orders. So that's what's happening. But at the same time, everyone that's moving their stop up, us retail traders, are getting stopped out, and that's so. And you can project that now onto a larger framework, such as the weekly chart, which is what we're doing here. We're trying to build up over the course of the week. We're trying to build up a thesis, and the closer we get to Wednesday, well, we've got Monday. We've got information from Monday and Tuesday, and we've also got information from last week. We've got last week's template that we can start building a thesis on. And given that we've got, well, I don't know whether you agree with me or not, whether we've got a bearish outlook for the US dollar, therefore, well, with the euro being so heavily weighted in that basket of currencies, around 40 odd percent, what we expect from the dollar, we'd expect the opposite in the euro. Okay, so I think I might actually have to jump off here. Bear with me. Have I overrun time? What time is it? 6 o'clock in the morning. Here, it's 8 o'clock there. I think I've got a meeting, guys, which I've completely run into. 1 minute. Yeah. Right. So I'm going to have to wrap up. But essentially, guys, what we're looking for today Now, all depends on these FOMC minutes. They come out my time. After all these years, I should know this off the top of my head. So 2 o'clock New York. So we've got plenty of time. No red news until then. Um, just note here, we've got this sort of dumping scenario, right? So the market likes to do the opposite. So when you've got a market that's dumping, we could expect the pump into that dump, right? Because same thing, you've got people that are in the money, right, moving their stops down, trading it, and we're looking for the squeeze on them. And once other participants, passive or aggressive rather, aggressive participants see that market start to pump up, they'll get on board as well. And you all of a sudden you've got a fresh wave of money to really push that up. All right. So I'm going to have to bail out here, guys. I'm afraid. Do ask questions in the analysis section. If you've got any of your particular currencies that you want me to look at, or any of our analysts, fire away over there. But I hope you've got some value out of today's hookup. We didn't get through the board, but we did go through some very important key concepts for which I'm using in my analysis that will hopefully help you guys along today and for the remainder. All right, so thank you for joining today. I've got a dash, do apologize, and I'll see you in the chat room in about half an hour's time. Okay, thanks, guys.